I was very critical of Powell for what he did in 2018 when he caved under some market turbulence, and then of course what he did after COVID. But I think he's following his own instincts at this point. The Fed economists were feeding him all that inflation is transitory stuff, and he believed it. And now he refers to them derisively as the economists, and he's not listening to them anymore. But I think his days are numbered, because I just don't see how the Fed can not get into what they call fiscal dominance mode, which is a situation where the federal government's financing needs take precedent over fighting inflation, over really any other mandate.
Welcome back to Soar Financially, everybody. Thank you so much for joining us. My name is Kai Hoffman. I'm the @JR Mining Guy on Twitter and also the CEO of the Soar Financial Group. I'm really looking forward to this discussion today. Actually, it's with David Hay. He's the Haymaker on Substack, and he runs a very successful Substack with over 15,000 subscribers. But he's also the co-CIO of Evergreen Capital, or Evergreen Gavekal Capital. And I'm really looking forward to this discussion because he's a fantastic macro analyst, and he looks at the macro space quite closely. Really looking forward to that because we're going to do a bit of an outlook for the rest of the year. The summer is allowing us to do that right now. And I'm really curious what his thoughts are on the Fed rate hikes. Do we need higher rates, lower rates? Where does he think things are going? Liquidity as well, because the US actually has issued over $1 trillion in T-bills just since June, since they raised the debt ceiling, and the market didn't even flinch. So I'm curious if we're still in a too low of a rate environment here as well. Now, before I switch over to my guest, very quick reminder, hit that subscribe button because it helps us bring in guests like David and other great commentators in the space on this channel. It helps us tremendously. It's highly appreciated and gives us some good feedback whether we're doing the right thing here or not. Now, that said, David, welcome on the program. I'm tremendously looking forward to the next minutes here.
Thanks, Kai. I think it's going to be fun. But I just want to start out with a quote of that great macroeconomic thinker, Yogi Berra, who said very famously that it's always difficult to make predictions, especially about the future. So with that as a qualifier, then I'll feel more comfortable in my anticipations.
Oh, absolutely. There's definitely a lot of forward-looking statements in this here, and please take all of them with caution. It's definitely not as financial advice. So reach out to your financial advisor to check all that. But David, to kick us off here, I think we need to sort of establish a status quo. Where are we right now? How's the economy doing? How are the financial markets doing?
Well, I would say on both, not as well as superficially appears. I think there's kind of head fakes going on in both regards. And for example, if you look at the economy, yesterday there were some interesting reports. There was a significant downward revision to payrolls, and actually that's just carrying on a trend that's been in place really all year, which I find most people are completely unaware of, even professionals. That non-farm payrolls, and again, this is I'm talking from a U.S. perspective, have been revised downward all 6 months of through June. The first 6 months have been reported so far. I won't be surprised if that's the case for July as well, especially based on the data point yesterday. So that's kind of typical, and it's not just typical of this cycle. It's typical when you get toward the end of economic expansions, is you get a lot of misleading data. And one reason in the jobs world is that you get the birth-death model playing such an important role, and that basically is an assumption, which is generally pretty accurate, that there's a certain number of new businesses being formed, and therefore they plug in, those new businesses are formed, they plug in how many people are being hired. And the problem is that when you get into a downturn, the early phases of a downturn, you're actually getting companies closing. So instead of getting births, you're getting deaths. So it creates a major swing factor. And so I think that's one reason why you're seeing these downward revisions. And a number of the leading indicators for the jobs market is also fraying around the edges. Like the quit ratio has gone down significantly. So usually when people are quitting, they're going to higher paying jobs because there is a dynamic job market. If you look at part-time jobs, they're going up, but full-time jobs are actually contracting. That's another kind of heads up that there's trouble in unemployment land. So that's one issue. But even if you look at retail sales, which of course came out here recently, is very strong. 5.8, I think, was the latest number, but over 5%. And that is a big number. But then you listen to the commentary from the companies, because again, these government statistics that are released contemporaneously tend to be so far off so frequently. And again, particularly when you're at an inflection point in the economy, which I clearly believe we are, but whether it's Foot Locker or Lowe's or Walmart, I mean, Walmart, people were happy with the numbers, but the comments from the CEO is that, consumers trading down to cheaper goods, it's under pressure. That was a message that also came out of Walgreens, which is, these are pretty stable demand type of companies. Macy's, a little bit more cyclical. Kohl's, Dick's Sporting Goods had a disaster of a report yesterday. So that's not the kind of stuff you expect to see in a robust retail sales environment. So I think the outlier, the questionable one, is the government data. And when it comes to the market, it's also the fact that you've got, as we all know, and this is just stating an absolute fact, is it's been a very narrow rally. If you take out the so-called Magnificent Seven, the market is up, probably in the 3 to 4 to 5% range this year. So nothing spectacular. The NYSE Composite, which is a far broader index than the S&P 500, is up about 4% in price this year. So once again, you look at superficially and you get a more optimistic message than when you drill down and actually look at perhaps more accurate data.
Great comments in there, and I want to follow up on the consumer spending part, because I asked you about that before we hit the record button as well, and you touched on retail sales as well. It seems like there's a bit of a bifurcation going on. It seems like discretionary spending on entertainment and other things at a very high level, travel even as well. While, as you said, like spending on food and other items, like the Walmart CEO, I remember him saying like 6 months ago, instead of buying the all beef sausages, now they're buying the cheaper sausages for their hot dogs, for example, right? They're substituting products, but the entertainment or the discretionary spending is staying very, very high, right? What does that tell you?
Well, I think you've got kind of that revenge spending that a lot of people have talked about coming out of the lockdowns, and people really want to travel again. And it's kind of like the in the stock market, the YOLO, you only live once type of attitude, in this case among consumers. So, but I think there's signs that that's slowing down too. I think it's a little premature to call that end game, but it's we are seeing some like falling airfares, which is surprising given I hear that airplanes are so jammed. But it's I heard Lizanne Saunders from Schwab on CNBC this morning, and she's a really smart lady, and she said lots of cross currents, and I think that's exactly right. And you can pretty much, if you want to be bullish on the economy, there's plenty of ammo out there for you. If you want to be bearish, I think there's even more, personally. But part of the problem, Kai, is that if you think about it, we haven't had a real recession since 2007. The very end of 2007 is when the MBER, which is the official arbiter of recessions in America, made the determination, way after the fact, of course, that we were in recession. The S&P 500 had made a new all-time high just 2 months earlier. And the economy actually looked fine even into the first half of 2008 until we really started to hit the financial crisis. But economic growth really didn't turn negative until, I think it was late summer of 2008. So my point is that so many people that are in the financial industry were either extremely young back then, unlike me, unfortunately, or they just weren't in the business at all. So they haven't really seen these preconditions. And the reality is that if you look at the GDP growth, which is, I think, going to be revised downward, and I'll explain that in a bit, but it actually is the softest it's ever been in a Fed tightening cycle. Usually the Fed starts tightening and the economy continues to do well because they start at a relatively low rate. And so the growth numbers tend to be pretty robust right up until the off the cliff moment. That's not the case this time. This is a very sluggish economy, even using the official GDP. Now, what's really interesting, I don't know if you remember this, but last year GDP fell in the first 2 quarters of 2022. And a lot of people believe, well, that's a recession. And I said at the time, I don't think so. It doesn't feel that way. And it was not confirmed by GDI. And GDI stands for gross domestic income. And frankly, that, if you look historically, it's been more accurate, and particularly at inflection points. So when there's revisions, which I think are coming, it's that GDP gets revised down to or up to, in the case of an early expansion, GDI. So, and by the way, GDI did not confirm last year's recession. It still showed that there was expansion going on. So score another one for its accuracy. But if you think about it, you've got already a profits recession. Even though people say, they're coming out better than expected, just because they revise them way down from where they were 15 months ago. So like S&P earnings are coming in over 10% below what the estimates were in the spring of last year. And then we've got a industrial transportation recession already underway. And that's despite this incredible boom in spending for new factories in America, but it's part of the reindustrialization of America, which I do think is a legitimate trend. Then we've got a recession in government tax revenues, and then GDI has gone negative. So that's 4 pretty important things that are already in recession. And then we could talk the yield curve, we could talk leading economic indicators. They're down 16 straight months. LEIs. And why do they call them leading? Because they lead. And yet people continue to blow these out. And once again, they're dismissing the yield curve. Francois Trahan is a great strategist. And he said inverted yield curves are easily dismissed, yet amazingly consistent. They've got a flawless track record when they've been inverted for an extended period of time and significantly inverted when we've had both of those conditions this time. So I think you got to be pretty heroic, borderline naive to blow off all these warnings.
Absolutely. A lot of warning signs out there, as you just said. And when you described 2008, it reminded me of the movie Big Short, where we've just seen it all before and it's playing out just yet again, right? Exactly what you said. It sounded like, okay, I was reading an article just now that it sounded exactly like what you mentioned. Like we do have a seemingly strong economy. The GDP numbers seem to be blown out of proportion just on one single factor from what I've read. And the S&P is actually marking it's not at all-time high, but at 4,500, it was trading at a very high level, right?
Indeed.
So I meant to ask you, because consumer spending, I just want to, maybe put a bow around that topic, but I had a question prepared for you. Is like, how much longer will we see the savings bulge remain? Sort of like, when do you see that dissolve? Do you look at the savings at all, like coming down? And is that something you're looking at?
Well, I think we have to. I mean, that's clearly been one of the supporting factors for the economy is all that, fake money that was sent out by the federal government and printed up by the Fed. And when we were doing MMT, I presume most of your viewers know that, but that's modern monetary theory, this idea that the government can just spend, at will. And if there's not enough buyers of the debt, which there weren't, then the Fed just simply, they create I call it their magical money machine and use that to buy government debt. So that's what we did. And that just, it was just like injecting adrenaline, mainlining it into the system. And so we had a very, very strong economy, shockingly. I mean, a lot of people thought in 2020 that it wouldn't turn around for years, and it turned around almost on a dime. And of course, and I wrote about this actually in 2019, early 2019, when I warned that I thought eventually we would be doing MMT in America. I had no idea that we would do it as soon as we did. But of course, the pandemic kind of accelerated everything. But I warned that the Achilles heel of MMT was going to be inflation. And of course, that's what we got. And in the summer of 2020, the 10-year Treasury note got down to a 0.55% yield. Now, I know you're in Germany and your yields were negative at that time, but 0.55 in America, when you had this tremendous blast of dual fiscal and monetary stimulus hitting, I mean, trillions and trillions of dollars. It was like, how are we not going to have inflation? So it was, it did create trillions of dollars, literally, not exaggerating, that, were in the system. And a lot of people sat on that money for a while. So they had, because for quite a while, they didn't have much to spend on. So once you did get the reopening, the vaccines were prevalent and people could travel, they could go to restaurants again, a lot of buying power. But from most of what I've seen, that's largely drawn down. It's that buffer, that catalyst is largely exhausted. Now, there are different studies. There's one guy, Darius Dale, very smart man, and he argues that there's still a lot out there. Don't think so. I mean, one fascinating thing, Kai, if you haven't looked at, is credit card balances. They're now over $1 trillion. It's up like $200 billion in the last year. The interest rate on that in America is over 20%. The interest rate on credit cards today is higher than it was in 1981 when Paul Volcker was doing his crush inflation, drive the prime rate over 20%. So, I mean, those consumers must be pretty desperate to be accessing capital at that cost. Credit card delinquencies are also soaring, as are corporate bankruptcies that I mentioned earlier. So again, lots of signs of stress. Supposedly half of all Americans couldn't handle an extraordinary expense of $500. Maybe you've seen that statistic. And I think it's a tale. I mean, to be fair, I mean, it's rarely black and white. There's usually shades of gray. And I think that it is a tale of two consumers. I think it's a tale of two corporate Americas, because if you're a cash rich consumer or corporation, you have very little debt or no debt, or you've termed out your debt, so your rates aren't going up. You've got this big pile of cash that you were getting zero on, now you're getting 5.5% on. Fine, that's great. Good. And I think that is supporting things. But there's a lot more people that are kind of hand to mouth than there are the people that are sitting back with their big fat money market fund balances.
Interesting. To follow up on that thought as well, maybe add some more fuel to the fire. Student loan debt repayments are supposed to kick in late September, October. It feels like, to me at least, I'm not following it too closely. It's being pushed back a month every time I look at it. But that seems to be coming up now as well. And as you said, the extraordinary expenses, credit card debt, I think that's just going to be fuel to the fire. What's your viewpoint on that? And do you think what will that trigger?
Well, assuming it actually is implemented, and I think it will eventually, yes, that will be a drag for sure. The other thing is people's, like if you want to buy a new car, new car prices are still way up there. They really come down. I don't think they come down at all. Maybe the increase is not what it was 2 years ago, but the interest rate cost of financing a new car has just gone nuts. And obviously, if you're trying to buy a home and you're not going to pay cash for it, which not many people can afford to do, home housing affordability is terrible. And yet there's been a bounce in the housing stocks, which I thought was really nonsensical. Fortunately for me, they've started to pull back a bit. But ERC, the Employee Retention Credit, my friend Danielle DiMartino Booth should be a great guest for you to have on, by the way. And she's been on this topic repeatedly, that this ERC, which is such a scam, and you see some high-profile celebrities in the U.S. hawking this thing almost every day on TV, and that's $20 billion a month, which tends to go to business owners. And she's convinced that it's really had a big positive impact on spending on travel and leisure, and taking the family first class to Europe for a vacation. But a lot of these things are going away. So that's why I think that we've been able to kind of postpone the reckoning, but we haven't eliminated it.
Sort of to touch on that as well, maybe as a follow-up question as well, is the inflation debate. I want to ask you whether we've conquered inflation, and if that all happens, what we just discussed, the consumer spending stops pretty much or slows down dramatically. Wouldn't that also mean that there's price deflation as well? So that inflation debate, like based on what we just discussed, because you need to create demand, you need to lower prices potentially to create that demand. Let's say cars, for example. Would that fit together? Would that make sense in that inflation debate?
Well, yes, but I think it is highly variable. So you're seeing, for example, a classic example of where you are seeing disinflation is with new home prices. So the builders are cutting prices because they have to. Now, existing homes are, homeowners are not, because they don't want to give up their low rate mortgage, and they've got this idea in their minds that their house is worth, let's say, $1 million when it's really only worth $850. So you've got that kind of paralyzing the existing home market, but the builders are able to, cut prices or basically offer people cut rate financing, buy down their mortgage so they can afford to buy a house, but that's of course hitting their margins. But they have big margins, and so they're still making pretty good money. But that's one of, I think, the rare instances of where you're seeing disinflation or, and maybe outright deflation. But you look at, like, Pepsi in June announced that they're raising prices 15%. Most of these consumer product companies that sell goods that we buy every day are raising prices in high single digits, low double digits. That's not very deflationary at all. And like I said, car prices, they're still really sticky. And then you're getting these big contract awards. I mean, the UPS drivers, 40% over 4 years, and American Airlines pilots, kind of the same thing. I think this UAW contract has the potential to be, again, highly inflationary. So you are starting to see kind of this cost push, or wage price spiral start to develop. And that's got to really worry the Fed. And I guess the commentary coming out of Jackson Hole today is quite hawkish, which I would expect. I think the Fed is not happy to see so much speculation in the financial markets. I don't think they're happy to see these kinds of price increases and compensation packages being negotiated. So I think this has been just the pattern of the market really for over a year, that they keep expecting the Fed to go to at least neutral, if not soon start cutting rates. And I think that's going to continue to be disappointed until there's a crisis. Now, we had a bit of a mini crisis, with the banks in spring, and the Fed reacted by kind of going back to kind of a stealth QE. I mean, they injected a lot of money into the system to keep the banks solvent because it really had the potential to go viral. So now they're going the other way. So this is one of the things that I think is greatly underappreciated by the soft landing, no landing, trampoline landing crowd, which is that you're getting not only this lagged impact of these almost unprecedented, at least since the early 80s, interest rate increases, but the Fed's back into a decided QT mode, which means quantitative tightening, where they're actually selling treasuries rather than buying them with printed money. So the bond market's biggest buyer is now a seller. And then you were talking about this earlier, the issuance. So this has been one of my two mega fears of this year, was that in the second half, we would have what I call the 4F scenario, federal fiscal funding fiasco, and where they swamp the market because the deficit, to be running a deficit that they are right now, which looks like it's going to be about $2 trillion for this year, that's just unprecedented outside of some kind of deep recession or war. It's just unprecedented with unemployment at 3.5 or 3.6%. So what it means is, and this has really shocked the market a few weeks ago for briefly, then of course it moves on, but they announced that they were going to raise $1.85 trillion in the second half of the year. And that did get people a little bit. So it was the same time that Fitch downgraded the US. So it was kind of lost in all that, attention on the downgrade, which I thought was the much less important issue. So you've got this explosion of supply, constricting demand, and also foreign central banks are not stepping up to buy treasuries. So the major ones are actually divesting treasuries and generally recycling that into gold or other currencies and bonds. And then you got the banks, which, they've got way too many treasuries. So how all this is going to get financed, I think, is a risk that is just tremendously underestimated.
The U.S. has issued like over $1 trillion in T-bills since June, since they raised the debt ceiling. I mentioned that in my intro. But the market didn't even flinch, really. Like that's what just picked up an article on Reuters or Bloomberg this morning as well about that. And another $600 to $800 billion, which sounds like nothing in comparison. But it doesn't seem to worry the market, because I'm also thinking of liquidity, because that money needs to come from somewhere, flow out of something to go into the bonds, and especially at 5% or 5.5% yield, that is quite attractive money as well.
Well, so far it's been able to be financed pretty easily out of the reserve accounts with the Fed. There's the banks have their reserves on the where they're getting the interest rate with the Fed, which they didn't used to get, and they're getting over 5%. Then you got the reverse repo thing, so it's somewhere around $5 trillion, and that's been drawn down to a fairly large degree to finance those treasuries. And it's kind of like, just changing from, one front row chair to another front row chair, because you're going from a 5% short-term yield to a 5%, maybe slightly higher short-term yield with a T-bill. I think where the real problem is not supposedly, they try to stay at about a 20% T-bill max, the federal government, the Treasury, when they finance. They don't want to be totally on the short end. So that part's easy because there's just so much demand for it, and it can come out of those reserve accounts so easily. I think where it's really challenging is the longer end of the Treasury curve. And when you're looking at the 10-year, and by the way, I mean, one of the most important charts in the world right now, and I could gladly send it to you, that you could post for your readers to look at, is the 30-year trend in interest rates on the 10-year Treasury yield. So we have clearly shattered that 30-year downtrend in yields, and really even 40-year downtrend in yields. And we've broken above the 3-year resistance point. So we've made a new high this week, higher than we were last fall on the 10-year Treasury yield. Very clear sign that we're in a bear market for longer term treasuries. Now, this is where it's tricky, because this would be normally the time where I would say you should be extending duration into 10-year or even longer treasuries. And I think there are trading opportunities there. I think you have to be very dexterous to take advantage of that. But the problem is that we've never had the situation where there's so much supply happening even before there's a recession. Imagine what that federal deficit is going to look like in the next recession. I mean, you could be talking 12% of GDP. So you just, where do the buyers come from in that kind of a situation? Does it force the Fed to come back in and be the buyer of last resort, maybe even the buyer of first resort? And frankly, this is one of I'll give you 3 outlandish predictions. going against my Yogi Berra quote. One is I think we could see long-term Treasury rates rise in a recession, which would be unprecedented. I think we'd see oil prices rise in a recession. Those two could be related. And I also think that we will see Mr. Powell exit stage left before he agrees to monetize the government deficits. I don't think he's going to play that game. And yet I don't see how there's any way the federal government can avoid that in the next recession. So I think Jay Powell resigns, and I think he'll be able to hold his head high after what he's done, because he could have caved in last year, as we said earlier. He didn't do that. And he's gotten inflation to come down drastically. Will it go to 2 and stay at 2? I don't think so. I think we've got structural drivers of inflation that will create these periodic declines, cyclical declines in inflation. Again, I'm old enough to remember the 1970s, and that's what we had back then. We had kind of a belated interest rate raising cycle. They got him. Arthur Burns back then got the rate a bit above inflation, and then inflation came down, and then Fed cut, inflation took off again, and a lot of that was an energy shortage, which I think we very much have an energy shortage that is, once again, I think it's tremendously underappreciated. So I think we're getting a temporary cyclical reprieve on inflation, but I think we got another kind of mini wave coming at us here in the near term.
I want to follow up on what you said about Jerome Powell and the Fed and how they reacted over the last 18 months here as well. Have they actually done the right thing? Has Jerome Powell done actually a good job, or how would you rate his efforts?
Well, I'd give him an F to begin with. Early on, he kept saying it was I wrote about this in my newsletter at the time, and I've been really ridiculing this. It's transitory type of thing when you had this incredibly inflationary environment of trillions of dollars of fake money that was sent directly to people. And it wasn't like the original QEs, because that mostly leaked into real estate and the financial markets. But this one really went to people that they could spend, and you didn't have really the ability to spend it on very much. You had a limited supply of goods and services even. So that's just a recipe for exploding prices, which is exactly what we got. So he was late for sure, but once he went into attack mode, he's been resolute. So I think, and I believe part of the reason for that, and he said this from all accounts, that he doesn't want to go down as a second coming of Arthur Burns. And while there, it looked like he wouldn't even be as good as Arthur Burns. But he proved himself last year. And in my book, I was very critical of Powell for what he did in 2018 when he caved under some market turbulence, and then of course what he did after COVID. But I think he's following his own instincts at this point. The Fed economists were feeding him all that inflation as transitory stuff, and he believed it. And now he refers to them derisively as the economists, and he's not listening to them anymore. But I think his days are numbered, because I just don't see how the Fed can not get into what they call fiscal dominance mode, which is a situation where the federal government's financing needs take precedent over fighting inflation, over really any other mandate of the Fed. And the Fed has too many mandates. That's another story about their problems, is that they're trying to do too many things. I mean, trying to keep low inflation and low unemployment is tough enough. And then you start throwing in all these other kind of stealth mandates, and it's truly mission impossible.
Absolutely. Not supposed to be political at all here. So
not supposed to.
Yeah, exactly. David, great segue actually to your book. You just brought it up in your answer here as well. It's called Bubble 3.0, Who Blew It, and How to Protect Yourself When It Falls Up or blows apart, actually. It's a great segue, because who blew it? Of course, I got to ask you that. And how do we protect ourselves? Because I think everybody's certain the recession is coming. It seems like it's delayed. Last few weeks, or actually last month, the buzzword was Godot recession, or Godot recession. I keep pronouncing it wrong. I haven't watched the movie, but we're just waiting for it. It's a recession that's never coming. There's talk of no landing, very very soft landing, right?
But waiting for Godot. Is that what you were saying? The waiting for Godot recession?
Yeah, exactly. That felt like it was the buzzword of July 2023, right? So I've heard it tons of times on Bloomberg and other financial media as well. So I was curious, are we all wrong here about the recession? It seems like it's coming, but how do we protect ourselves from it? And maybe part A of the question is, who blew it?
Well, my view, no doubt, the Fed. I mean, the Fed has allowed these bubbles to inflate. And the first one was really kind of just benign neglect, the tech bubble. they just really didn't do much. I mean, Greenspan made his infamous or famous, whichever way you want to look at it, irrational exuberant speech in 1996. And by 1999, when the NASDAQ was, going up at, just straight up, and the stock market, U.S. stock market, was more expensive than it was in 1929. It was really the greatest stock market bubble in U.S. history. I would argue it actually was exceeded in 2021, but it depends on how you measure it. I would use price to sales, and on that basis, it was significantly more expensive in 21 than it was even in 1999. So that pops, and then they, as I said earlier, then they create the second one in housing. That was much more of the Fed, not just standing back and allowing it to happen, but encouraging it. I mean, Greenspan was telling people to take out variable rate mortgages when the housing market was already, extremely overpriced, and there were all those terrible mortgages being created, and he was starting to tighten rates, and so those adjustable rate mortgages were going to, be a noose around people's neck. But so that was pretty bad, that whole episode. And then Ben Bernanke was in denial about how bad the housing bubble was, and he famously said, or again infamously said, in the summer 2008 that the problems were confined to subprime. So just another bad move, or series of moves by the Fed. Then, of course, we get the global financial crisis. The whole financial system almost implodes, and they come into the rescue. I mean, they do a good job of preventing a systemic meltdown. Now, other people would say, but what doesn't happen is you don't get the flushing out process. So you're just delaying and making it worse for the next one. So then they start all the QEs, and then that drives asset prices to the moon and hits the crescendo in 2021 and all those negative yielding bonds. And when people get paid to take out mortgages, they're going to take out mortgages and buy more house than they can really afford. And you just get these instead of one bubble or maybe two bubbles, you get countless bubbles. And that's what we got. So I think clearly the central banks, not just the Fed, but a lot of the Western central banks, and I throw the Bank of Japan in there, deserve a lot of blame for that type of misallocation of capital and repetitive speculative manias. So that's who blew it. How you protect yourself is, so that's, right now that's the dilemma. Is the question is it time to go long bonds? And as I said earlier, normally I'd say yes, this is the perfect time to do it, but I don't think so. I think that it's better. I mean, again, some trading rallies, absolutely, and some people say, look, there's a huge short position on the long treasuries, but it looks like that's probably due to the hedging of very long duration, cash portfolios. So I'll put that under kind of the I don't know category. That's kind of confusing. But I think what's a safer play is to use a barbell of those short treasuries that pay 5.5, and emerging market debt. I think emerging market debt with funds that, and there are a number of closed-end funds in America that do target the stronger economies and bond markets. And you got countries like Brazil, where they reacted much quicker to the inflation spike. They got interest rates up to 14%. Inflation's back down to 4 or 5%. Now they can cut rates. They can cut rates a lot. The currency's going up. And there's a host of emerging market countries that look like that. So I think that's a much better way to play the longer end of the yield curve. So I think that's one logical way to do it. I think commodity prices, they got crushed. That's why I kind of thought inflation would come down cyclically. But now these commodity prices are starting to go back up, and led by oil. And of course, oil filters through the economy in so many ways. Now it has run lately, so I'd be a little careful about it. We put out a table pounder buy in our newsletter on energy back in mid-June, and we fortunately got pretty lucky, caught it pretty much at the trough. So we believe that energy's got a major tailwind to it. We've loved uranium, but uranium has really run here lately. If you bought any uranium, I would just nibble on it. But I just think the nuclear renaissance is coming. I kind of scratch my head about your country, and they seem to want to continue to close down nuclear reactors. But there's 60 nuclear reactors under construction around the world. Not a single one in America, unfortunately. But I do think America is going to go with small modular reactors, which I'm a big fan of. So just bottom line, I think investors should be focused on nuclear. I think it is going to be a really long-lived revival. I think you can make a lot of money over a 10-year period by playing, the most attractive nuclear vehicles. Unfortunately, the miners themselves are a little tricky because they're like Cameco, which is the premier, has had an explosive move. We had that, did really well, sold it too early. But if that one gets hit hard, and I actually did put out a little bit of a buy notice on that one, I think it was last spring, whenever it dipped down to the low 20s. But just in general, I think commodities are going to be attractive. Lithium would be an area I'd look at right now because we had one of our lithium stocks that went straight up earlier this year. It's come down hard, and I think it will run again. Lithium is going to be in short supply, as are most of these essential components or inputs for the great green energy transition. Lithium, cobalt, nickel, copper. Copper looks quite attractive long term. The major U.S. copper producers had a significant pullback correction. So there's definitely places to be. Gold, I think the gold miners are pretty intriguing. One of the blue chip ones yield 4%.
Newmont, 4% dividend yields. Fantastic.
Yeah, and so I'm actually writing this up for my newsletter for tomorrow, if I can get it done, is that, people say, well, don't buy gold because it doesn't pay anything. Well, if you can get a 4% yield versus, say, a 4% treasury or 4.25 today, I guess it is, but essentially the same yield, and you've got something that's scarce. I mean, I just did a podcast with my great friend Grant Williams yesterday, and he relayed from, Tony Deaton?
Oh, yeah.
You know who he is? He's in Switzerland. He'd probably be a great guest for you, too. But Tony Deaton's a brilliant man, and Grant did a podcast with him a few years ago that stuck with me, where he said, just invest in scarcity. Where is there scarcity? Don't look at all this price momentum and stuff like that. Don't chase NVIDIA after it's gone up, 500% or whatever. Don't be buying treasuries when they can create them at will. My other friend Simon Mikhailovich calls them candy wrappers. Don't buy candy wrappers. Buy something that's got real intrinsic value to it. And personally, I think there's nothing more valuable than energy, even more so than gold, because you can run the world without gold, but you can't run the world without energy. And we've had such a misallocation of capital over recent years because of the great green energy transition that, on any pullback, I basically would say to your listeners, be looking at these, the best energy producers. Right now, they're a little bit pricey, so be careful. But there's definitely places to be. And I think the U.S. reindustrialization theme, as I mentioned earlier, has got a lot further to run. So XLI is an industrial ETF. It's had a beautiful breakout. One thing that I really like to look at, Kai, is multi-year breakouts, just like we're talking about on the treasury yield. Because when these things are a range, and the longer the range, the more meaningful the breakout. Just go look at a chart of Microsoft back in 2013, so 10 years ago. It had been at a trading range for 13 years, as had the S&P, by the way. They both broke out, and it was off to the races. And I got the one on Microsoft. I missed the one on the S&P, which was really stupid on my part. And same thing on breakdowns. I mean, you look at some of these stocks that have Disney, if you want to look at one right now that looks really scary on a chart, DIS, one of America's favorite companies, doesn't look good. And these things break support, and they just repeatedly, I mean, if you'd followed that on Credit Suisse, when Credit Suisse broke support this spring, you could have saved a ton of money. So that's my free little thing. Pay attention to these. Paul Tudor Jones calls them range expansions when they break out of and again, the longer the range, the more meaningful the break out or break down.
Fantastic, David.
The hard way, by the way.
You dish out a lot of free advice, but also you run a paid for newsletter on Substack. So, the haymaker.substack.com, and I couldn't find you on Twitter. Are you on Twitter?
We are. You should be able to find us there. What we'll do is I'll email you the Twitter handle. I don't know that off the top of my head.
No, that's fine. Because I'm very active on Twitter as well, so that's where I get a lot of my insights and information from. Because it's very quick, and there's some brilliant minds, as you said, like Grant Williams and Danielle DiMartino Booth. I'm speaking with her early November. I'm really looking forward to that conversation. Meeting her in New Orleans actually at the conference, so I'm looking forward to that. David, this was a hugely insightful conversation. I really, really appreciate your time. We mentioned your newsletter already, but. Any closing words? Anything we should be wary of for the next 4 months of the year?
Well, I'd still get back to the 4F scenario. The federal government's fiscal funding fiasco is really a serious issue, and I guess I would end with a thought from you know who Lacey Hunt is? If you ever follow Lacey Hunt, brilliant man, former senior Dallas Fed, but a guy that, like us, runs real money. He's been a very successful bond manager over the years, so he's not just an ivory tower kind of guy. And he points out that the fiscal multiplier has gone negative. And the reason I think that's so important is if he's right, and I think all the evidence confirms that he is right, that as you spend trillions of dollars that you don't have, the deficit spending, while it creates a near-term kind of artificial steroid type of boost, long-term, it actually retards economic activity. It's a negative. So the big point I'm trying to make here, I made this with Grant yesterday, is that we're really in the throes of a triple tightening. So not only are we getting the tightening from the interest rate increases, which have been huge, we've also got the balance sheet shrinkage, which is running at $1 trillion annual rate, and this fiscal multiplier where we got the, kind of the sugar high is now going to flip the other way. We've never seen this before. And I think that one, I mean, you really hardly ever hear anybody talk about double tightening anymore. They did for a while, but nobody's mentioning triple tightening. And so that's one I would say is maybe a good closing thought.
Fantastic. David, super insightful. Really, really appreciate your time. And let's do this again very soon. I'm really looking forward to maybe before the year end. We'll do a bit of an outlook for 2024.
There you go.
Fantastic.
It's really a privilege to be on your show, and it's nice to meet you. I think we've made a new friendship.
Fantastic. I love it. Awesome. We'll deepen that. And I actually might be in Kellogg, Idaho very soon. So I'll stay on for a second. I need to say some closing words here real quick, because I hope everybody else, not just myself, enjoyed this conversation here with David Hay. Lots of great insights. He tried to give a bit of an outlook, of course, of what is happening in the next 4 months. Very difficult to predict. Black Swan could derail everything, of course. But really curious what the Fed is going to do. Jackson Hole meeting is still going on while we were recording this here. So Jerome Powell is only speaking tomorrow, Friday, after recording this here. So I'm curious what he has to say. I don't expect much, to be honest, in terms of market direction. But it is interesting times. And if you want to see more, you want to learn more, follow us, hit that subscribe button right there. Because I know 80 to 85% of you watching are not subscribed to the channel. Please change that, because I want to bring guests like David, Danielle DiMartino Booth, and others here on this channel. It helps us tremendously. Thank you so much for tuning in. We'll be back with lots more. Thank you.